Let me ask you something straight, because this is where so many retirees get blindsided. You spent your entire life saving for retirement. You did what you were told. You put money into your IRA, your 401k, maybe even a 403b. You delayed gratification. You sacrificed. And now, just when you think you can finally breathe, the government shows up and says, it's time to pay. That, my friend, is where RMDs come in. RMD stands for Required Minimum Distribution. And the key word here is not minimum, it's required. Because once you reach a certain age, the IRS is no longer going to let you keep your money growing tax deferred forever. They want their cut, and they don't ask politely. Now, as of today, that age is 73 for most people. That means the year you turn 73, you are required to start withdrawing money from your retirement accounts, whether you need that money or not. Let me say that again, because this is where people make costly mistakes. You must withdraw the money even if you don't need it. And whatever you withdraw, it counts as taxable income. That's where the real issue begins. Because most retirees are not prepared for the tax shock that comes with RMDs. They think, oh, I'll just take a little out. No. The IRS decides how much you must take out, not you. And how do they decide? They use something called a life expectancy factor. It sounds technical, but here's what it really means. They look at your age, then divide your retirement account balance by a number based on how long they think you'll live. So let's make this real. Say you're 73 years old and you have $500,000 in your traditional IRA. The IRS factor at that age is roughly 26.5. So you take $500,000 and divide it by 26.5. That gives you about $18,868. That is your required minimum distribution for the year. You don't get to negotiate that number. You don't get to say, I'll skip this year. You take it. Or you pay a penalty. And that penalty used to be brutal. 50% of what you failed to withdraw. It has been reduced, but trust me, you don't want to go anywhere near it. Now, here's the part that most people don't think about until it's too late. That $18,868, it's not just money in your pocket. It is added to your income. And that can push you into a higher tax bracket. It can increase the taxes on your Social Security. It can raise your Medicare premiums. And suddenly, what you thought was a simple withdrawal becomes a chain reaction of financial consequences. This is why I need you to understand this clearly. RMDs are not just about taking money out. They are about managing the tax impact of that withdrawal. Because if you don't plan for it, you will lose more of your money than necessary. And that's not okay. Now, let's talk about fear. Because I know what some of you are thinking. What if I take too much and run out of money? What if taxes eat up my savings? What if I didn't plan properly? Those are valid fears. But here's the truth. The biggest mistake you can make is ignoring RMDs until they hit you. Because by the time you're 73, your options are more limited. The real power comes from planning before you get there. So what can you actually do about this? Let me give you something actionable, because knowledge without action is useless. First, understand which accounts are subject to RMDs. Traditional IRAs? Yes. Netsazed? Yes. Netsazharon? Yes. But Roth IRAs? No. And that right there should make you pause. Because money in a Roth IRA grows tax-free and is not subject to RMDs during your lifetime. So, one strategy, and this is a big one, is something called a Roth conversion. This means you take money from your traditional IRA and move it into a Roth IRA. Yes, you will pay taxes on that conversion today, but once it's in the Roth, it grows tax-free, and you are no longer forced to take RMDs from that portion. So instead of being forced to withdraw and pay taxes later, potentially at higher rates, you take control and pay taxes now on your terms. That's how you shift from reactive to proactive. Now, is a Roth conversion right for everyone? No, because if you convert too much in 1 year, you could push yourself into a higher tax bracket right now. So this has to be done strategically. Sometimes it's about doing partial conversions over several years, especially in those early retirement years before RMDs begin when your income might be lower. That window is golden, and too many people waste it. Another thing you need to think about: qualified charitable distributions, or QCDs. If you are charitably inclined, if giving is part of who you are, this is powerful, because once you're 70 and a half or older, you can take money directly from your IRA and give it to a qualified charity. And that amount counts toward your RMD, but it does not count as taxable income. Let me repeat that because this is a big deal. You satisfy your RMD requirement, but you don't pay taxes on that portion. That is smart giving. That is strategic generosity. And it can make a meaningful difference in your overall tax situation. Now, I also want you to think about timing, because when you take your first RMD, you actually have a choice. You can take it in the year you turn 73, or you can delay it until April 1 of the following year. Sounds like flexibility, right? But here's the catch. If you delay, you'll have to take 2 RMDs in that next year. And that could push your income even higher, which could mean higher taxes, higher Medicare premiums, more of your Social Security being taxed. So just because you can delay doesn't mean you should. You have to look at the bigger picture. Always. Now, let me ask you another question. Do you know how much your future RMDs will be? Most people don't. And that's a problem, because if you don't know what's coming, you can't plan for it. You should be projecting your future RMDs, looking at your current balances, estimating growth, understanding how those future withdrawals will impact your taxes, because this is not about guessing. This is about being intentional. And let me tell you something that may be uncomfortable to hear. If the majority of your retirement savings are in tax-deferred accounts, you have a tax problem waiting to happen, not a savings problem. A tax problem, because every dollar in those accounts is a future tax bill. And RMDs are how that bill gets collected. So your job starting right now is to manage that future tax liability, not ignore it, not hope it goes away. Manage it. Maybe that means doing Roth conversions. Maybe that means diversifying into taxable and tax-free accounts. Maybe that means working with a financial advisor who actually understands retirement tax planning, not just investments. Because investing and tax planning are not the same thing, and you need both. Now, let me bring this back to what really matters: peace of mind, because at this stage of your life, that is everything. You don't want surprises. You don't want stress. You don't want to sit there at 73 or 75 or 80 and think, why didn't I plan for this? You want to feel in control. You want to know that your money is working for you, not against you. And that starts with understanding something as simple and as powerful as an RMD, it's not just a rule. It's not just a calculation. It's a turning point, a moment where your retirement savings shift from accumulation to distribution. And how you handle that moment will determine how much of your money you actually get to keep. So here's what I want you to do after listening to this. Don't just nod and move on. Take action. Look at your retirement accounts. Find out your balances. Estimate what your RMDs might look like. Think about your tax bracket now and in the future. And ask yourself, what can I do today to reduce the taxes I'll pay tomorrow? Because the earlier you act, the more options you have, and the more control you gain. And that, more than anything, is what retirement should be about. Not fear, not confusion, but clarity, confidence, and control over the money you worked your entire life to build.